Real estate bubble to be extreme. Wow, is it really that bad? How exactly does that work? Well, here's the thing. At this very moment, banks in the United States have been running negative account balances for 14 straight quarters in a row. So what does that have to do with the real estate bubble? It's because these commercial banks are the primary institutions providing the loans. They're the biggest lenders in real estate. And let me tell you, this real estate bubble is even bigger than the subprime crisis back in 2008. That's because the subprime crisis was just a bubble in the residential real estate market. But this time, it's a bubble in commercial real estate too, like big buildings and skyscrapers. It's gotten to the point where people are calling this real estate bubble a hyperbubble. So to make it sound a bit cooler, you could call it an extreme real estate bubble. Let's check out the data together. You can support the information about this extreme real estate bubble in this video by scanning this QR code. Or if you want to support the Time Money Monster channel, it's super easy. Just hit like, share, and leave a comment to chat and have fun with us. But what I'd love most is if you could subscribe, so next time I upload a new video, we can meet again. Sound good? Thank you. Before we get into the topic of the extreme real estate bubble, I want you to take a look at these numbers first. This data is from the FDIC. What you see here, unrealized losses in this graph, represents the accounting losses of banks. If you count the bars going down, there are 14 bars, which means banks across the United States have had accounting losses for 14 consecutive quarters. And in the first quarter of 2025, the accounting loss totaled $414 billion. In the second quarter of 2025, the loss decreased a bit, down to $397 billion. But even so, that's still a huge negative number. So you might ask, if we're talking about the real estate bubble, why do we need to talk about the accounting losses of commercial banks? Well, it's because most of the loans that commercial banks give out are to the commercial real estate sector. And here is a chart showing commercial real estate exposure, or CRE. You can see that a large number of commercial banks have lent more than half of their loans to real estate. The reason their balance sheets are in the red is because the value of the assets, which are mostly real estate held by the banks, has plummeted. Looking at this chart, you can see that office prices in the city have dropped dramatically by 52%. Right now, the value of commercial real estate in the US, specifically office buildings, has fallen by more than $557 billion. This drop is compared to 2019. For example, in Chicago, just look at this headline. The price of a building has dropped by 90%. It used to sell for $22 million, but now it's down by 90%. It dropped to just $2 million, or in this case, from $38 million down to only $4 million US dollars. Take this one, for example, the Broadway building, a landmark in Manhattan. Blackstone once sold it for $605 million. Now, the building has been foreclosed and sold for only $140 million, which is less than a third of its previous price. They used to buy at those prices. And the fact that commercial real estate prices have dropped this much isn't just because it's hard to find buyers. Even finding tenants is tough right now. Let's look at this chart. You'll see that commercial real estate in big cities currently has high vacancy rates, meaning there are a lot of empty spaces, with vacancy rates in the high teens to over 20%. Take the Bay Area or Austin, for example. The vacancy rates are sky high because there just aren't any tenants. With vacancy rates at 20%, that's what led to this chart. This is data from July 2025. It shows that the rate of late rent payments has shot up dramatically. And when the prices of real estate, which make up most of the assets for commercial banks, drop, it causes these banks to have negative book value. This has gone on for 14 consecutive quarters. That sounds scary, but do you know what's even scarier? It's not as scary as when these assets lose value, but the real fear comes when these assets reach their debt maturity dates in 2025. These commercial buildings, whose values are dropping, are now reaching the point where their debts are coming due, quite a significant number of them. According to data from the MBA, or the Mortgage Bankers Association, there are commercial real estate mortgages totaling 20% that are due for repayment, which amounts to $957 billion. Out of the total mortgage loans, the amount is as high as $4.8 trillion. Now, if this chunk of debt, those $957 billion that are coming due, if most people can't pay it back, who's going to get hit the hardest? The ones who get hit are the lenders. And who are the lenders? The commercial banks, of course. They're definitely in trouble. If that scenario really happens, I'll have to make a whole separate video about it. If commercial real estate ends up unable to pay back their loans, it's going to be a huge shock. And this actually already happened in 2023, if you remember. Like I mentioned at the beginning, if this real estate bubble bursts, it's going to be even bigger and more severe than the 2008 subprime crisis. That's because back in 2008, it was just the residential real estate sector. It was a housing bubble. But this time, it's not just that. It's a commercial real estate bubble, big buildings, properties used for businesses and commercial activities. And the reason people are calling it a hyperbubble is because it's not just commercial real estate. Residential housing is also in a bubble. Home prices in the US right now are insanely high. If you look at the chart, you'll see that the home price index for 2025 is at 299.9. That number is shockingly high, and it's even higher than before. That's even higher than in 2006, which was the start of the 2008 real estate bubble crisis, the subprime crisis. Back then, the bad mortgage debt triggered a global financial crisis. And the reason why the 299.9 figure is so scary is because it's already starting to drop. If you look back at the subprime crisis, prices peaked in 2006 and then started to fall, which led to the 2008 crash. Now it's the same thing. The 299-point mark, we're at the peak now, right? And now it's starting to drop. So if history repeats itself, the crash will happen just after it starts to fall a bit. Right now, home prices in the United States are already starting to decline significantly. The year-on-year home price index has dropped to just 2.8% growth. The rate of existing home sales is at its lowest point in the past 9 months. That's why the number of mortgage delinquencies is also rising. CNBC has reported the delinquency number. In April, the delinquency rate was at 0.92%. By May, the number of mortgage delinquencies had increased to 1.03%. This is a higher rate of delinquency than for auto loans or credit card debt. And right behind that, the number of homes being foreclosed by banks is also rising. What's happening in the US housing market right now is that the average sales rate of existing homes has dropped by 0.7% since 2022. It's not a recent decline. And what's even more concerning is that the average price of new homes in the US has plunged by about 14% since this past May. This situation has really made a lot of construction contractors pull back significantly. According to data from the National Association of Home Builders, they conducted a survey on the confidence home developers, such as construction contractors, have a confidence level below 50. In this chart, contractor confidence is graded with 50 as the cutoff. Below 50 indicates a lack of confidence. For U.S. developers, confidence has been below 50 for 15 straight months, recently hitting just 33. The survey also shows that 38% of developers are cutting home prices, with an average reduction of 5%. This means there are both higher and lower price cuts. As home sales slow down, the inventory of unsold homes increases and more homes remain on the market. Looking at data from weather.com, in about 22 major cities, you can see that the blue zones indicate a very high number of unsold homes. So if you ask why there are so many unsold homes, after hearing all this information, it's really not surprising. If you look at this other chart, you'll see that home prices have been rising much faster than wages for a long time. You can see that wages are represented by the orange line. It's been growing steadily, but at a slow and gentle pace, which can't keep up with the blue line, which represents home prices. As a result, right now, the gap between wages and home prices is as much as 5.3 times. Basically, if you want to buy a house, you'd have to work for 5.3 years without spending a single cent on anything else, which is just impossible. So aside from all the official data, government statistics, and unemployment rates, is there anything else that shows that people are really struggling? With the real estate bubble that's forming right now, let's try using a cute little indicator, shall we? This indicator I actually got from the Gold Silver channel. They used it there, so I thought I'd share it with you guys. It's an indicator that reflects consumer behavior, basically the habits of internet users. It's not a government indicator, so it feels more genuine and real. For example, sometimes the government says, oh, the unemployment rate is low, inflation isn't a problem. The stock market might look great, but data from Polymarket Breaking shows that there's a huge spike in people searching for the term health vismage, which refers to mortgage debt. People are desperately looking for any kind of help, just anything to help them out. The number of Google searches for this term has hit an all-time high. Just like stocks can hit all-time highs, the number of people searching for help with mortgage debt is also at an all-time high. As you can see in this chart, the number of people searching for help with mortgage today is even higher than the number of searches back in 2008 during the subprime crisis. There's another term too. People are searching for help me. And also the phrase give car back is coming up a lot. Like, what should I do? My car is about to get repossessed. This data comes from Dash Paul's account. The number of Google searches for give car back is also at an all-time high. And then moving over to the Gold Silver channel, they also introduced another very interesting economic indicator, the Cass Freight Index. This specific index carefully measures both the total quantity and the overall value of goods being exported from the United States by air. Basically, if the national economy is performing exceptionally well, there should naturally be a high volume and a high value of goods being exported by air, right? But right now, the Cass Freight Index in the United States has dropped by 9.3% compared to last year. What does that mean? The stock market is high, so why is air export volume so low? Actually, I have a third piece of information that could support the government side, suggesting that, yeah, the stock market is surging and hitting all-time highs, which means the economy is good, but the volume of air freight is still low. Some people say, hey, if the economy's good, then shipping should be high, right? No, you have to look at the stock market more closely. The stocks that are growing are AI stocks. Does AI get shipped by air? No, you just pay for a subscription. So this kind of information is for considering both sides. And finally, before ending this clip, let's take this into consideration again, whether the bubble will burst or not. I got this information from the UBS Global Real Estate Bubble Index. 2025. This report is free to download. Just search for this name and you can download it right away. You'll see that the key factor, or the bubble score, is extremely high. The red color is at 1.73, which is the highest in history. And in this report, it also mentions that if the bubble is really going to burst, where would it start to burst from? They even scored it for us, showing which regions or cities in the world have the highest scores. The bubble is most likely to burst in these places, with the highest risk in the world. According to UBS, if the bubble's going to burst, it will probably start in Miami, since that's the most severe. Next in line are Tokyo, Los Angeles, Dubai, Amsterdam. They're all on the list. Even Asia is included. All this data means that the global real estate bubble is extremely inflated and ready to burst. But honestly, whether it will actually burst or not, or when it might happen, nobody really knows. It might just be waiting for something to trigger it. Something could set it off and cause an event to happen. So what do you think? Is this real estate bubble story extreme enough for you? Thanks for the coffee from that, Jez.